our big premise is follow the trend, follow big money, follow risk management rules, and follow big money. This is one of my favorites. So stock prices do not go up by accident. A surge in demand is caused by institutional investors. 75% of the float is really these high quality, they're going after these high quality leaders. It's what we call billion-dollar fund managers. So I'll quote Bill. So funds are like elephants jumping into a bathtub. They're simply so big the water rises and splashes all over the place. And that's what we very much track at Invest with Rules. And I think IBD does a great job of it as well. And if we move to the next slide, the only, I would say, differentiator is there is a bunch of data that exists from, I'm looking at about $1 trillion. It's not the entire market. So to be clear, I am looking for an edge. But with Invest with Rules, it's a 30-day lag. And so as an example, the data is available at the end of September, and then we cut it, clean it, and what we're simply doing is we're delivering it right at the end of October. So 30 days lag. The 13F reports, I want to be crystal clear, this is not inside information, it's wildly ethical. But the 13F reports, they come out at the end of the quarter, which is just happened, 45 days after the end of the quarter. So on, call it the 14th, 15th is where people start to share what these hedge funds are typically up to. But if you go back like a month or you go back 2 months, then the Invest with Rules data has the potential to be, in this case, like it could be even more. It's like 45 days better or 75 days better. So at certain points, it's way quicker. But if we move forward, what we're simply trying to do is take kind of recent data on the next slide, and we have this universe of stocks, and we very much weight what the funds are buying. So we have the universe, what the funds are after. We have an earnings growth kind of cut. And very simply, it's usually in the neighborhood of around 10% forward earnings. So that's where it could be a rocket ship type company that we all love at IBD that are on like that pop up on my market search charts, or it could be kind of a slower company that's just kind of chugging along nicely. But the one thing that we did, back to the rules and adjustments, we are putting more of a weight on what we'll call VOMO, volatility adjusted momentum. So think appreciation or whatever the return is, rate of change, and we're going to divide that by the average true range. So we're very simply, we go through this process. We're looking for these short-term and long-term uptrends, and we're trying to compare. Now we're going to relative. We're saying, okay, well, if there's, let's say this is an issue that a lot of investors face is, okay, I'm ready to buy something. I have 3 things on my plate. Which one do I go after? And I think that's one of the hardest things that we all battle. And this is one way VOMO can be a good screener to say, okay, well, who's done the best with the least momentum, with the least volatility, and maybe that raises one to the top that should be worthy of your time, acting more like a quant versus based on your emotion.
Mm-hmm. And when you say rate of change, is there a time frame that you're associating with that rate of change?
Yeah, great question. So we're typically looking out at roughly about a month. We're typically looking out about in the neighborhood of 6 months, and then a little bit after a little over a year. So we're looking at it over multiple time periods to see, because there are times where the IBD rating caught it too, where like if you go back a couple months ago, Tesla was super low on ratings, on relative strength line. And now it's a rocket ship. So it is important to have different time frames when you do your volatility adjusted momentum, because it's interesting just how much, look at that line is just, I mean, absolutely rocketed, and the election obviously made it just absolutely rip.
And I'm just showing a couple other things. The RS rating over, relative strength right now is 95. 4 weeks ago, it was 52, to your point. 6 months ago, it was 17. So again, to your point on how Tesla has changed.
Yes. And I think, if you don't mind heading back to the slide just so I can cover that one piece. So what I want to do is just deliver what we're looking at very simply, and hopefully it gives you an idea or two. Please manage your risk tolerance, as always. But in general, so every month, so we cut this data and we just do it monthly. So I know a lot of the The data keeps getting refreshed constantly. But if you don't mind moving to the next one for me, but just once a month, and then we apply our trend roadmap on top of this. So here's a really good example from just a day or two ago. So at the top we have Boston Scientific, BSX, medical device maker. In the bottom we have Marvell. And okay, so year to date, Boston Scientific is up 56, Marvell's up 47, so that's kind of a clear differentiator. But what is the VOMO on the year to date? What's the volatility adjusted momentum on the year to date? And the answer is BSX is a much stronger volatility adjusted momentum than Marvell. And you can kind of see the green rectangle, just how tight that is versus a Marvell chart over the same time period. And the question that I always ask is, for anyone, could you have sat through that August pullback with Marvell? And for a lot of people, the answer, unfortunately, is no. So that's where adding that extra layer kind of comes in.
Yeah.
So,
and I like that you used two stocks here of relatively the same price. So it's kind of you took out that scale issue, right? It's hey, this is kind of a little bit of an apples to apples comparison here, and yeah, it just kind of shows again which one would you rather have, which one is easier to hold, which one kind of pays you for the risks that you're taking.
Yeah, thanks for appreciating my extreme nerdism of price and year to date. And
we always appreciate nerdiness here. That's our goal.
The joy of being this loving it. So, but that's kind of the VOMO. And then I think on the next slide I share our report. So I want to deliver this to you just to share kind of what we're after. And again. Number 6 on our report from a ranking perspective, again, big buying. We're looking at buying. We're looking at momentum with a volatility look. We're looking at earnings growth. But you can kind of see this is stack ranked since the end of October when it was delivered. But I mean, app loving. I mean, amazing, right? 89% so far. It's only the 20th of the month and it's already up almost 90%. Full disclosure, we do own Axon Enterprises. I'll cover that in the next slide. We own a few of these tickers. We don't own them all. And again, a lot of the stuff at the top will be overheat.
Well, just for disclosure purposes, I own your top 7. So I'm kind of right there with you on a lot of these. And granted, I don't have the same percentages in some of these. App Lovin', for instance, I recently bought because I just couldn't stand it anymore. Watching it go up without me after I sold it just before September 11th when it started its move. But yeah, so I'm with you on a lot of these. That again, we're coming at it from different ways, but we're kind of coming up with the same stocks.
Yeah, and I think that's important because, the CanSlim model is amazing. And it brings the growth and it brings this unique rule set, which I love. And we're just heavily weighting it towards fund buying is really what we're up to. And it makes sense. And it helps me to, you have 2 lists. Can you filter it down? Can you make the list smaller and can you make the list more manageable during the day when it's go time? And I think in general, you're going to see some of these at some point pull back. Now, I'm very much not advocating for any member to go buy all these because there's some below the line that have not done as well. But this is the top chunk that have done better than the S&P. But month to date, since this was released, this list is up 7.3 compared to the market up 1.85. And I like to look at this from a perspective of the big money. Even during the volatility of the last kind of teeny tiny pullback the last 2 or 3 days, they're not letting go of this stuff, which I think is really interesting. Even on a kind of a flat to down day today, it's up 0.29. So they're going after these names. And at some point, follow rules, it's going to all turn and they're going to at some point let go some of this. And I just don't want for anyone to have great gains and give it all back. But I would say this is kind of this is our shopping list. And then very much the VOMO, the short term and the medium term, it helps us because we are 30-day lag. So the short term volatility adjusted momentum lets us kind of deal with the fact that this isn't yesterday's buying from these funds because that's not ethical. So because this will then say, okay, well, what are they really going after still? And then that helps just kind of refine the list to what deserves our attention.
Just real quick, kind of talk to me about once you have this kind of list, and again, we're big believers, right, in that concept where you have so many stocks to choose from. Everything about the paper, Investors Business Daily, Market Surge is about kind of filtering that list down to a more manageable number and getting to the forefront, really the stocks that are most worth your time, that have the best odds of success. Nothing is 100%, as you've made very clear, and we are right there with you. But what, two things, I guess. Number one is, okay, once you have that filtered list, where do you do your entries? How does it start? Oh, this is something I'm going to buy now, I guess, to start out with.
Yeah. Do you mind moving to the next slide? So the short answer is, we need for there to be gas signals. So short-term and long-term uptrends. That's mandatory. So number one, it needs the trend roadmap. So we have the list. We go to the trend roadmap next. So what's the trend? And very simply, what we're saying is we're going to stack rank it. So if you see, as an example, at the very bottom is our watch list of things. Some things we own, some things we don't own, and the things at the top, politely, we do own. So you'll see the short ST VOMO, so a Garmin. I don't own one of their fancy watches, but it is drastically outperforming the S&P 500 over the past, call it, month. And same with Intuitive Surgical. So we are using this volatility adjusted momentum, so return divided by its volatility, to have a scoring system. We absolutely want the trends to be there as well. And we also, we have a little bit of mechanisms to say, using relative strength, using extensions from our entry points to say, okay, before we even enter, what is our risk? Kind of back to rules. The kind of the other famous Bill O'Neill book, Bill O'Neill quote is like, would you ever like buy a car without brakes? So we need to
Right.
know what our risk unit is before we even enter the trade. So as you can see, we've had a great run. I mean, Amazon is an example where it was on our list and it fell back. So the funds maybe kind of paused some of their larger buying. Axon has been really solid for us, obviously. We are heading towards more financials, so we have early positions in American Express. We added a second position in Goldman Sachs. There's times where you'll see the rank, but we are trying our best when capital comes free, so to hold about 9 or 10 tickers, and this is our shopping list at the bottom. So trend is your answer, volatility adjusted
Okay.
momentum is your answer, and we're trying to not buy things that are extraordinarily extended from short-term risk units.